Hello everybody, this is Lenska with Lenska Realty, and this is another edition of the San Diego Real Estate Market Update, March 2020. I'm a real estate broker and investment specialist and try to make more money for sellers and get buyers a good deal. I also serve on the board of the largest investor club, SDCIA, which meets every second Tuesday every month. So besides meeting on Tuesdays, we also had a great event on February 22nd where it was all about ADUs and how we can maximize our rental properties. And thanks to a lot of great sponsors like Loan Depot, the Norris Group, Crest Backyards Homes, and Maxable, and many other like Home Depot and Rebuilding Green, ADU Plus, Golden Age Financial Solutions, and Mathis Custom Remodeling, plus our silver and bronze level sponsors. If you missed it, I will give you a short synopsis. But we had Senator Bob Wieckowski do the keynote, and he was blown away by our enthusiasm, by the turnout. We had 350 people attend. So I got a nice handwritten note. You're asking, who is Bob Wieckowski? So he was the architect of the first bill that allowed a single-family zoned lot to add an accessory dwelling unit, which is called a granny flat, casita, and so on. So, but there were parking restrictions which got with the new SB 13 eliminates this dreaded parking requirements. So, and if you are close or half a mile from public transit, you are not required to add a parking space. Your existing driveway can satisfy this requirement. Now, you don't have to worry about the added construction costs that come with adding a new parking space. Plus, you'll save a lot of more time. Senator Wieckowski's SB 13, cities are no longer allowed to require owner occupancy for at least 5 years. So that means you can go on vacation, rent out your house, and be happily traveling ever after. SB 13 also puts pressure on the city's permitting office. It used to be 120 days, now a more reasonable 60 days is appropriate. Impact fees are waived. Finally, say goodbye to impact fees that your ADU is less than 750 square feet. If your ADU is over 700 square feet, you're still in luck. Fees will be made proportional to the square footage of the ADU. And also HOA can't kill your ADU dreams. So if you're in an HOA, please check with them and see what you're allowed to build. 2 units on one properties, yes, for sure. You can actually have a junior ADU, which is within the walls, and an ADU. So we're calling this triplexing. But still, owner occupancy is required if you have a junior ADU. Here the summary of changes. One that we didn't talk before, that is a no limitations on the size of the ADU if created within the space of an existing structure, which is very interesting as well. And you also allowed 50% of the existing proposed dwelling living area, but at least a minimum of 800 square feet. If you need more information, here is the housing development website and link, and you can also find the latest and greatest on that website. But don't forget to subscribe to this channel, because all the presentations we had on the February 22nd, including our experts that talked about the ins and outs of building those dwelling units, will be uploaded to this channel right here. So, and to follow up we are going to go on tour. We're going to go on an ADU tour. ADU tour is, we have several homes with ADUs finished, under construction, in the planning, new, old, modular guest houses, tiny houses, open house tour on Saturday, March 21st from 10 to 2 p.m. And more details to come. You can sign up at sdcia.com, or you can go to Meetup and find us there under the real estate investing field trip. So now we are back. Uncertainty. We have a world economy impacted by the latest, the coronavirus, but I feel the strong housing market, which I'm going to show you how strong it is probably weathering out the storm. So we talk about sales and inventory numbers, interest rates, employment data, home purchasing sentiment by Fannie Mae, home builder sentiment, affordability, NODs, notice of defaults, and trust deeds. And we have our real estate investor sentiment, where I asked a group of investors if they think it is a good time to be an investor. And last month in January, we only had 10 raising their hand. This time we had 45. So we're all optimistic that the current conditions will bring us some deals. So deals are to be had, but San Diego County Detached in February rose to $678,000, which is an 8.5% year-over-year return. So may I point out that in January 2017 we went straight up. January 2018 we went straight up. But this year we had a very strong fourth quarter where we've seen in September prices going up, and especially when you look at these last ones, even November and December, where you normally see a downturn. So I would say this is a very strong real estate market. Maybe a little bit too strong. Maybe the corona, we could withstand a little bit of coronavirus to take the overheated, or cool off the overheated housing market a little bit. Practically the same story here. The San Diego County attached median sales price was $450,000, which is a 9.4% year-over-year return. Here are the key statistics. Median home price altogether was $594,000, 8.5% increase. The median house price for detached, we talked about $678, attached $450. We had increased pending sales of 19.6% from last month's 14.5%. Another story are the active listings. We had 4,576 listings in February, which is practically like last month's, down about 35%. Market is moving very quickly. We have 34 days, which is an improvement over the 37 days from last month. Pending sales also very strong. So we had a lot of inactive listings down, pending sales up. So no wonder we have no inventories. So how many units actually did we sell? We sold about 2,232, which is up 5.1%. So let me ask you guys, if we only sell 2,232 units, detached and attached, and we have 12,500 real estate agents and brokers, how many agents are going to go hungry to bed? So please, I always appreciate your referrals, and call me with any questions you have. That's just to really show you where this inventory is. How low can we go? Detached down 40%. Active listings attached down 31.8%. So we have never seen a low inventory like this. 3,464 listings between the detached and attached units. And what do you need to make some money, right? So this slide is really, the story here is that the labor force participation rate about doubled for women since 1950, and that's the squiggly red line, where the men between 25 and 64 peaked about 1956. This graph shows you the labor force participation rate growth since 2000, and as we clearly can see that the ages 65 and over, men and women, have in go. I mean, I'm going to Home Depot, and who's working there? I see a lot of people in their 60s and 70s work there. Labor force participation rate, look a little closer. I want to draw that attention to the ages 16 to 24. Obviously, that dropped. It lets me believe that these people are going back to college and ramp up student debt, which is increasing tremendously. So here we see that your median household income by age bracket. So the blue line and green line, ages between 35 and 54, those are your peak years where you should also have your most income. But as we can see, the 65-year and older are also the winners here, because I think with paying into the Social Security and working later, they definitely improve their household income. Median household income growth by age bracket, so you can see percentage-wise, it's even more dramatic, that 65 and older. So where's your next buyer coming from? Definitely, my bet is on the baby boomers, seeing their financial strength and potential. So we're now back to Fannie Mae. This is a sentiment consistent out of 6 components, as in, is it a good time to buy or sell? Will home prices go up? Will mortgage rates go up or down? And how confident are you by not losing your job? Or do you think your household income has increased over the last 12 months? And no big surprise, we ended up, and that was all before the coronavirus, at 92.5%, which is down slightly, just half a point in February from one of the higher marks in January. So we see that, is it a good time to buy or sell? There was not a huge change month over month, even so we're up 12 points year over year. Selling conditions year over year we're up, but not month over month, because if you sell and you're not moving out of state, where are you going? So it's a little dampened by definitely by the move up buyers. So then the home prices outlook, people really don't think prices are going to go up. Obviously, that was before the coronavirus. Now interest rates just have dropped, and what happens if interest rates drop? Home prices will go up, especially in our very tight inventory market. But here's some good news. People are still very sure about having their jobs, and the best news is that the change in household incomes, that the percentage of Americans who say their household income is significantly higher than it was 12 months ago has increased to 32%. And it's significantly lower, actually, is that kind of went steady. So significantly higher is at 21%, up 5 points. So here it is as a graph. We're down and we're also net significantly higher is at 21%. And we always want to know, are rents increasing as well? And this survey says that on average, Americans expect rental prices to increase 5 points over the next 12 months. And they also expect home prices to rise about 3% over the next 12 months. So everybody is very bullish on housing and rentals. And speaking of rentals, as we know, we have it, San Diego has not the best cap rates. So I want to draw your attention to the Mobile, Alabama, so that actually rents went up 2%. Actually, we had in New Jersey, Cumberland, and Vineland, it went up 7%, a 3-bedroom rental amount, okay, which is actually that one is lowering the median sales price. So probably where rents go up, the prices go down. So, and if you look at Alabama, Montgomery, Alabama, the rental price was just down -2, but the median sales price shot up 34%. So these are very, we also have right now here in Wayne, Michigan. So if you like, counties in Baltimore and Macon, Rockford, Detroit post high-level rental returns. Obviously, counties like San Francisco, San Jose, and New York posted the lowest rental returns due to their high housing prices. So we're talking about gross rental yield. So we have seen many areas actually going up. Just the ones that are marked with the arrow, they went down. You can study this a little bit more. And just out of fun, I calculated with the median home price in the city of San Diego and maybe getting $700 a week in rental income. Our 2019 annual gross rental yield is 7%. So you definitely can add an ADU and maybe bring that one up for the ADU at 10% because you already own the land. If you want to bring it up anywhere more, maybe you can turn those ADUs into grow houses. Hunt for rental yield is big. Rents rising faster than wages in 55% of the markets. So maybe they're already tapped out a little bit, like San Diego County, Orange County, Los Angeles County, lots of California counties on the list. But wages rose faster than rents in 196 of the 432 counties, and this is a realty track stat. I didn't put the logo on here. So you have Cook County in Chicago, Illinois, Queens County, New York, Clark County, Las Vegas in Nevada, and Tarrant County in Dallas-Worth, Texas. Check out these rental markets for the hunt of rental yields. We know interest rates are ridiculous low. They have been really the lowest they have been. So take advantage of it. The applications for refis shot up about 79% after that last interest rate drop. Okay, so housing affordability index is a little bit improving because we have lower interest rates than we had the quarters before. That's good news. So what are you required? So we're kind of looking at the LA area. So in order to afford a medium priced home, you need to make about $108,000. $100,000, which is up 100% from our low in 2012. You only needed to make about 53,000. So 8 years later, how times have changed. Looking in California, how about Lassen County? It's more affordable than the average 57% in the US. Definitely our least affordable county is San Francisco, and San Diego is in 12th place from the bottom. So we still have pent-up demand. We still have a very strong job market in San Diego. Prices have been going up. I did skip over the home builder sentiment because the builder sentiment is unchanged and is still very high. So, but let's face it, the new construction will not come to the housing rescue in 2020. We're simply still not building enough homes. Also, what might help a little bit will that the international buyers activity actually slow down, and as you can see around the globe, people have probably more economic worries, and now with the coronavirus, the health worries. So we will see some material supply chains affected, which might affect the new build home prices as well. So we will see and wait and see. So there's a little crack in the armor, even so it looks at first sight that obviously foreclosures have been going down, and they have been actually going down 1% from the previous month and 9% down from the year ago, but still overall we have 26,858 foreclosure filings. So which are the 19 states, or amongst the 19 states, year-over-year increases in foreclosure? We can see that we have California, Tennessee, Georgia, Illinois, and Ohio. And if we look at the metro areas that posted year-over-year increases in foreclosures, San Antonio, Los Angeles, Riverside, Nashville, Tennessee, and Chicago, Illinois. Still not as bad as New Jersey and Delaware and Illinois. And we are at the end. Thanks for listening. Watch out for other episodes. And if you need any real estate services, please see what I offer from buyer representing, listing agent, flat fee listing, broker price opinion. If you're working on a fix and flip, or if you want to participate in some of my educational events on Meetup.